Hi, everyone. It's Grant Abbott speaking. Thank you very much for turning up to this one. And really, the cover page says it all. The cover slide is that UK pension transfers, if they're done right, can either pay no tax or virtually no tax on the money going into a QROPs SMSF in Australia. Just as an aside, it can't go into an industry or retail super fund, unfortunately. Or alternatively, you may end up paying 80% taxes if you make a significant mistake. So when we have a look at it, there's a lot of laws and a lot of legislation to go through. So I'm going to get through to our QROPs, our latest QROPs deed that Ash put up this morning and we've been working on. So I'll take you through that. Suffice to say, none of this is achievable, and none of the strategies are going to look at it as achievable unless you do have a good solid QROPs SMSF deed. I'm going to go through what I've done in the deed to look at that. But before I do that, we need to look at both the UK and the Australian superannuation laws and pension laws. And unfortunately, this is going to be a pretty deep dive. So what I will do is, for those of you who ever go through QROPs, you're going to need to ensure you see this a couple of times. And it'll be sitting in our strategy centre. And I think we're now in our strategy centre up to around about 90 different videos. So we're certainly starting to build up a really big library for all of our users, which now stands at 900 users, thanks to Ash and her team. So with this one, highly specialist, I'm going to have to go in and do the hard yards. Unfortunately, I shouldn't say unfortunately, fortunately for you, I went around and did a big research yesterday afternoon on the people who say that they can do QROPs and a lot of that stuff, which can be facilitated. It's not a difficult process, but when you start interacting with different taxation regimes, it can be an absolute nightmare. Of course, 80% taxes is something that we don't want. And in particular, a lot of the QROPs guys tend to be UK residents, so they know what's going on in the UK. However, it's when it comes into Australia that is the real detail. And I'm going to have to take you through the sections. I'm going to read the sections out. We're going to go through those. So this is probably going to be a very, very hardcore session for you. But again, if you need to look at it a couple of times, feel free to do so. Okay, so let's go through. So just as a broader aspect is where we've got a UK pension member and their plan allows them to withdraw their pension, and effectively they've met the requirements of the plan. It's a bit different from Australia, where we've got preservation ages, retirement, accessing. Over in the UK. They are tightening up a lot of areas, but when you do take a pension amount from the UK, 25% can be taken as a lump sum tax-free. The rest of the amount of money that's come out or sits in a UK pension plan is effectively taxable in the UK. So that's for a UK resident taxpayer. Given all the COVID-19, I would have thought there'd be hundreds of UK residents probably wanting to come over to the sunny life in Australia, where we seem to have plenty of vitamin D, which may or may not have an impact on COVID. But I would have thought that there's certainly be a big migrant shift. Anyway, the way it works is that because if it was taxed in the UK and it's also taxed in Australia, and so we're talking about straight pension income, because it's only income from an Australian superannuation fund received by a taxpayer that effectively is tax-free. If you receive income from a foreign pension fund, effectively is taxed at the ordinary marginal tax rates of an Australian taxpayer. Now, here's the problem, is that if you're taxed in the UK on that amount of money, and then it's also taxed in Australia, you end up with double taxation. So, for example, if I receive £50,000 from my UK pension plan, to be taxed at my marginal tax rate over in the UK, although I would be treated as a foreign resident and taxed there. Likewise, that amount would then be up to the exchange rate of the Australian, which I'm not sure what it is at the moment, but let's say it's 100,000 Australian dollars, it would be taxed here as well. Now, to prevent that, we have a double tax treaty between UK and Australia. And Australia has around, I think last count, around about 200 double tax treaties with countries like the US, Luxembourg, Singapore, not Hong Kong, because it's basically was a tax haven, although no one should have any money in Hong Kong anymore. But with a double tax treaty, what it says, and it's generally around about Article 11 or Article 10, it says that it's only the country in which the person is a resident that the income can be taxed. And so that is the deal, not the deal breaker, that's the negotiating breaker to ensure that there's no double taxation between the UK and Australia. And I've spent much of my life looking at double tax treaties, and this is certainly one of the best. So what it would mean, though, is that if we receive that foreign pension income in Australia, remember I'd rounded it up under exchange rates to $100,000, then it will be fully assessable in Australia. And of course, that would be a bit of a concern for our clients, particularly when they can see individuals receiving money out of Australian super, BT or BT wrap, or from an SMSF, and it's coming out tax-free, particularly once they're able to achieve it and they're over their preservation age and retired. So it's not a bad position, at least there's no double taxation, but unfortunately at marginal tax rates we're in a pretty bad position. Now, alternatively, a member of a pension plan living overseas, so UK pension plan, may request their administrator in the UK to transfer their accumulated pension amount to an overseas pension plan. So we need to go and have a look at that. I'm going to look at the laws. But what I'll do is let's have a look at a bit of a case study, just a very basic one, and then we'll start doing a pretty deep dive. Then we'll come back to, obviously, the QROPs stage. So what I've got is John Mann comes to Australia in 1994. He's age 31 at the time. And at that time, his pension plan was Australian $60,000 equivalent. I think in those days, probably would have been about £22,000. That's how strong the UK pound was at that time. John is now age 57, and his UK pension plan's increased to $450,000. So that's not a bad increase over that 26-year period. John wants to bring his pension to Australia so he can retire at age 59. He's given his preservation age, he should be right in that element there. So from that perspective, what are the circumstances? He's got money already in Australian super of $350,000 from SGC and salary sacrifice and contributions being in. So what are some of the circumstances and some of the issues that John faces? So let's just bounce out of there and start to go and do some of the hard work. And I'll send these links through to you anyway, so you've got a fairly good idea. So the first one is the overseas transfer charge guidance. So I'll shoot this through. This is a publication by Her Majesty's Revenue and Customs. So I'll just go through here. So this guidance applies from the 9th of March 2017 to the overseas transfer charge. The new tax charge arises on transferring to QROPs or qualified overseas pension schemes unless the transfer is excluded from the charge. So what happened is they've made numerous changes to these pension schemes. It used to be you just be able to transfer them to any Australian superannuation fund. But as from March 2017, they're quite significant changes. So let's go through and just have a look at these. I'll just again preface it. So this guidance applies from 9th of March 2017, so we're already done that, to the overseas transfer charge, which we need to have a look at. The new tax charge, which is currently that arises on transfers to QROPs, so we need to know what that is, unless the transfer is excluded from the charge. So what we need to do is we want to set up an Australian self-managed super fund that is obviously a qualified, recognised overseas pension scheme, and secondly, that it is excluded from the charge. So let's go through and have a look. So a QROPs is a pension scheme established outside the UK that is broadly similar to a registered UK pension scheme. So effectively, from that perspective, Australian super, the BT wrap, effectively a self-managed super fund would all fit in there. They're all pension schemes. Now, a QROPs can receive transfers from registered pension schemes free of tax up to the lifetime allowance, which in the UK is quite significant. Now, so that's a good thing. It's free of tax. However, from the 9th of March 2017, certain transfers to and from a QROPs will be liable to a 25% tax called the overseas tax charge. So this guidance explains the circumstances in which the overseas tax charge arises, who is liable to pay the tax charge, how to pay the tax charge, the information regime supporting the overseas tax charge, and changes to QROPs regime as a result of the introduction of the tax charge. So this is really super fresh fresh off the boat virtually. Okay, so we won't look at existing scheme managers. And you'll find a little bit later on why most Australian funds or non-self-managed super funds don't fit the bill. We won't look at the current registered pension scheme administrators or members themselves. Let's go straight through to the overview of the overseas transfer charge. Because what we're seeking to do is, one is if we set up the QROPs, we don't want to get hit with a 25% charge, obviously. So the overseas transfer charge applies to certain transfers from a registered pension scheme to a QROPs and from a QROPs or a former QROPs to another QROPs. So, for example, a lot of the Australian plans, Australian Super and all that, they were all set up to be QROPs, but now they're not QROPs anymore. So that you may transfer to an existing self-managed super fund. In fact, they need to do so. So importantly, the overseas charge doesn't apply to transfers the member requested before. Obviously, that's included. Okay, so let's just go down. So who's liable to pay? So let's go down here. The amount of the overseas transfer charge is 25% of the transferred value. This guidance tells you how to determine that. So who's liable to pay the overseas transfer charge? Well, we won't really worry about that. That's effectively going to be the administrator with withhold. Okay, so which transfers from registered pension schemes are chargeable? So the member has not provided the scheme administrator with all the required prescribed information before the transfer is made. So that will simply just be a straight 25%. That's why when you're dealing in this, it's really important to get in front of the administrator and find out where the client is and write to the administrator, and they may well have it on their relevant page in terms of a pension plan, what the process is. So what we need to do is make sure that we've got the QROP. Now, this is the important area for us, and this is absolutely crucial. So if we have a look at it, you're going to be up for the tax unless of this. Now, none of the following 5 conditions are met. So if we meet these 5 conditions, then effectively there is no overseas tax charge. So the first off is the member is a resident in the same country in which the QROPs receiving the transfer is established. So that's the first one. So that if we're doing an SMSF QROPs, and we'll look at that, then the member has to be resident of Australia at that time. And when we look at that, we go back to our double tax treaty, and it's going to be a tax resident of Australia. So does everyone understand that one? So it's absolutely crucial. You must show, first off, that they are a tax resident of Australia. Now, a lot of this information, you might find that the scheme administrator is going to want to see beforehand. They may or may not, but anyway, because they're the ones who actually have to do the withhold of the 25%. The last thing you want to do is get them to withhold, pay it to HMRC, and then you've got to go and get the refund. And then you're going to have to establish your lease. So you've got to be a resident of Australia. We don't have to worry about the European Economic Area. So the QROPs is set up by an international organisation, so we don't have to worry about that one, so it's not a problem. The QROPs is an overseas pensions, public service pension scheme, and the member is an employee, or the QROPs is an occupational pension scheme, the member employer is sponsoring employer. So if we have a look at that, it would be just treated, so none of the following 5 conditions are met. So that's not a bad. So we've actually got this one here. The members are resident of the same country which the QROPs receiving the transfer. So we're okay with that one. So that's our out. we don't need to rely on these four. Does that make sense? Now, a transfer request is made when a member has made a substantive request to the scheme administrator. Again, this is the key issue of their pension scheme in which the scheme administrator is required to take action in relation to the transfer. This means an instruction from the member to transfer X pounds or X percent of their pension funds to a named overseas pension scheme. A casual inquiry is not a transfer. Now, when we go down the track, you'll see that non-concessional contribution rules will come in. So we have to have a look at this. We don't need to pull out all of the money from our pension plan straight off the boat. We can actually do it in stages. So we've met the condition here. They're resident of Australia and the QROPs is going to be an Australian fund. We're going to make a request. We can do it in stages if we want. In relation to a member, as I said before, means residence for tax purposes. So you have to show that they're Australian tax resident. You'll be able to get that if you're an accountant. You're certainly going to know that you'll be lodging as an Australian tax resident. So which transfers from registered pension schemes are not chargeable? So this is what we basically want. So transfers which are not recognised transfers will be subject to the unauthorised payments charge. The overseas transfer charge will not arise on those charges. So that is basically a 40%. So if you're not a QROP, remember what we're looking now is a QROP that might be subject to the 25% if we're not a resident. So if I'm a resident of New Zealand, I set up an Australian self-managed super fund, there's a 25% charge. But if I'm just a straight overseas pension plan, then I'm up for 40%. For example, if I try to transfer my UK pension plan to Australian super, then effectively I'm up for a 40% charge because it is not a QROP effectively. So if we go down there, and I'll just go down a little bit further. So the transfer process, the process transferring from registered pension scheme can be divided in the following stages. This is really important. Member requests the transfer, but you've got to be there for them because most of your members really don't know what they don't know. So best you've got to do that. The scheme administrator manager tells the member what information they need before they can make the transfer. One is that the QROP has actually been registered, so you need to go to HMRC. The member should give the scheme administrator manager the required information. So make sure you get that right up front. Due diligence checks should be completed by a scheme administrator. The scheme administrator establishes if the transfer is liable to the charge, calculation of the tax charges, transfers made, information, reports and tax payment post-transfer. So that is the whole process from the UK perspective. So that's essentially what we want. So again, you need to be involved very closely with the administrator. Get on the phone, have a look at their website, find out what their requirement, because each and every one's different. It's, for example, it's like dealing with Host Plus versus dealing with, for example, a Westpac superannuation fund. They're completely different beasts. Okay, so is the transfer taxable? We can go through and have a look through that process. Calculating the tax charge, reports, so on and so forth. So have a good look through that. But again, most of the stuff is actually going to be relating to the scheme administrator. So I want to take you away from that. So let's go through the process. We know our steps in order to achieve that. Where are they? Okay, example. I think it's down here. So if we go down here, the steps, we had this there, the transfer process. We've got those there. Let me just take this, just so it'll be easier for you when you see your slides. I'll go through that and I'll put that, just give me a second on this. And I'll go into the slides. New slide. Okay, so there's the transfer process. So UK. Sorry I haven't done this before, but I just want to make sure that as we go through that you guys are pretty well aware of what's going on and where I found it, how I found it, because again, we need to look at the laws. Okay, so what I'm going to do now is I'm going to bounce out of here and I'm going to take you in. I take you through another HMRC guideline, but what I want to do is set up our QROPs here. So I'm going to go into our home. Again, if you have a look, I'm on the strategist, so I've got unlimited documents. This is not, if you're part of the LY Protect, this won't be part of your LY Protect, so you're going to have to pay $99 for this. So I'm going to go down to our SMSFs, Establish, Maintain and Upgrade. And you'll see that we've got an SMSF deed of variation, which I'll do that, but we've also got a QROPs establishment if you haven't established it before, or we've got one with a corporate trustee. So if I did a corporate trustee here, I'd be doing my normal company. So I'd be doing my SMSF specialist company. So let's have a look through here. There's plenty of stuff about the product, general information, FAQs I've got all there. So have a look at that. But what I'm going to do is start the document. It's a pretty easy document to do. I need to choose a folder. If you haven't seen this new feature, we've put it in where you need to make sure you've got a folder. So you should have it for clients. Let's say we've got a new folder, and this is going to be for the Mann family. Now, for this one, because obviously we're going to set up this self-managed super fund, he's going to roll his Australian super amount into it. We'll find out if his spouse is going to roll hers in, so on and so forth. But I'm assuming here that we've already got a self-managed. Actually, we haven't got a self-managed, haven't we? So let me cancel that one. Let's cancel out of that one. Let's go back. I want to keep it. So I'm going to use SMSF establishment with a corporate trustee. So I go through this process. I'm going to go to the add a new folder, the Mann family. I'll save that folder. Then I go into the Mann family, which is the Mann family. And then I start that. Does that make sense? So I've already set up my SMSF corporate trustee. So let's go through the process. So I'm going to put the Mann QROPs SMSF. I'll put in here, you generally put in your own logo tag, but I'll put the Abbott-Family one in there for you to see. I can go through my save answers. As an aside, just if any one of you want to do data captures really easily for any of our documents, we will be building them. But all you need to do is just go to answer summary here. And that is our whole interview process, all encapsulated into an answer summary. So it's a great little data capture, or if you want to ask questions of your client over the phone to complete. But anyway, we go through here. Look, it's not that difficult. So we've got the Mann family QROPs SMSF. Now, I'd suggest you want to put that in there because when this is sent over to HMRC, effectively we want to make sure, and we'll go New South Wales, we want to make sure that we've got QROPs everywhere you're going to see. So what's the trustee company's name? We'll just put QROPs Pty Limited. We've got the ACN back from them. So 1, 2, 1. So it's pretty exciting. We've got the address, which is our accountant's address. And we've got 2 directors. So we've got 2, we put that in there, confirm. They're actually going to be really surprised at how easy this is. We've got John Mann, and he's going to sign. And we've also got his wife, Susie Mann. So I'm going to press that and that. I go to the next. And then effectively I've got the initial members. So the first one, of course, and this is why you don't need an application form under any of our establishment documents. And the reason I say this is that what we do is all the initial members actually sign on to the deed. So what you need to do an application form if they're already part of that deed. So I think that that's absolutely crucial. So let's go through 5 Smith Street, New South Wales. However, if you do have a new member, and if we do want to do new member, then we have to do an application form. So we do the members meeting. Now, this is for obviously to call the trustee. So call the trustee notice. What we do is we need to, in case, what we set it down, because in case we ever change the trustee from company to individuals, all we need to do is we actually need to put in place which is best. Vote each you cast a vote for proportional vote. So let's vote on proportional vote. We then go down to the assignments. You got John and Susie, and then we go into our finish. And then we'll go to QROPs. And seriously, that's going to be 5 minutes to do a QROPs deed. It's not that difficult. Once you've got the company, then you're basically off and running. So hopefully, oh sorry, Paul, yeah, maybe it's my internet. Hopefully, it's better. So, unfortunately, where we are at the moment, things go off and on. But please let me know, Paul, again, if you can hear me or there's issue. Oh, thanks a lot for that, Paul. I don't want to do that. It'll all be recorded anyway. As I said, that you'll be able to get access to this later on. So I'm going to download that document. So you can see down here, I've got my QROPs deed. Now, again, you can see here, it's important the way you set it up, because if this is going to go over, because the first thing is you're going to need to get this registered on the HMRC. So let me just see if I can find it for you. HMRC Register of QROPs. Okay, so if we go here, we can get our register of QROPs. So I can go through, check the recognised overseas pension schemes, and you can see there's quite a lot of information here as well. So let's go through, and you can see, I just want to show you, for example, so in Barbados, there is the DGM Registered Retirement Savings Plan. Belgium, we've got a couple, and remember they've got the European one. Now let's go through, I just want to go up a little bit. So we've got Austria, and then we've got, let's have a look. In fact, I know that Briggs as well. He used to work with me at Citicorp. Can you see something, guys? What do you think we've got here? These are Australian self-managed superannuation funds. You can see here, where's Australian Super? Let's go down and have a look up the top. Okay, you can't see CBUS isn't there. Australian Super, nope, not there. Again, and you can see these are all self-managed superannuation funds. Does that make sense? Okay, so you need to check the thing. So you need to find yourself and get on the register, and then you'll be published. And once that's published up here, then it's easy for your, the pension scheme administrator needs to check it. So look at all these ones: AM Gamble, Amblin Super Fund. Again, this is I love this. This gets me excited, and that's how weird I am anyway. But let's go back and have a look at our oops, so that's the wrong one. Let's have a look at my oops, the last will of testament. Oh, here we go. Let's have a look at my QROPs. So you want to throw everything. So what I've done is I've gone OTT in terms of QROPs, so that everyone sees. Now, what I'm going to do is I just want to show you again. This is the way I like to do things. If there is an ATO ruling, or for example here, an HMRC ruling on what we're looking at, whether it's a pension plan investment strategy, for example, with investment strategy, I like to load them all in up front into the, and I think that it's completely different to what everyone else does. I like to load it up front to protect you, because if the client comes back and says, look, I didn't know what I was doing, you say, well, hold on, you signed off and you actually had a look at all of this stuff. So let's go through here. This is the conditions a scheme must meet. So this is when we go through the process. So, so for the scheme managers, we won't go through this. Registered members, let's go through. So let's have a look here. Overview of changes to the overseas pension scheme and conditions. First one, to be a QROPs, the scheme must meet the conditions to be an overseas pension scheme. There are two main tests. So the first one is the regulatory requirements test or the tax recognition test. Okay, so if we go down from the 6th of April 2017, we find the regulatory requirements test doesn't meet. So this is what we want to do, the new regulatory requirements test. So currently, if there's a regulator of the type of pension scheme in the country or territory in which the scheme is established, the scheme must be regulated by that regulatory body. So first off is, who is the regulator of the Australian SMSFs? It's the tax office. So therefore, we meet that first condition. So if we have to point that out to our administrator, then the first condition is that it's the Australian Taxation Office who regulates the SMSF, the pension scheme. So we don't need to worry about this. We've got that. We don't have to worry about occupational pension schemes, so we go straight to non-occupational. Occupational, for example, is more the SGC stuff. If the scheme is not an occupational pension scheme and there's a regulator of such schemes in the country or territory which is established, the scheme must be regulated by that regulatory authority. And so you can tell that because you've been, you can just go in and do your super fund lookup, show them all your stats out of your super fund lookup. So if the scheme isn't regulated, it fails the regulatory test. Then if we go down here, so for Australia, and this is the HMRC. For Australia, self-managed super fund is a non-occupational pension scheme. The regulator of all SMSFs is the Australian Taxation Office. For other superannuation funds, it's APRA. So this shows you how many UK residents are actually trying to take the money out of Australian. So we've effectively met all that requirements. So let's go the S. So from 6th of April, to be a ROPS, a pension scheme must be established in one of the following. So we've looked at that. It's got a double taxation agreement. So a country or territory with Australia has got a double tax agreement, which is the case as well here. So now this is important, the pension age test. So again, note, Australia and the UK have an extensive double tax. It just shows you that everything's sort of targeted towards Australia, so good on them. So currently, the pension age test requires payments can't be made to the member if they are under normal pension age unless they are retiring due to ill health. There are certain authorised payments a registered pension scheme can make to a member under age 55, for example, refund, or here, a serious health lump sum. So if we have a look here, essentially this is straight out of the HMRC. I've got there the Abbott-Family QROPs deed. Now let's go through. So remember this is for the establishment. We've got the trustee. Remember I did man QROPs. If you can, I definitely put QROPs in the name of the deed. They don't have it. You saw when we had a look at the HMRC, there's not that many people who've actually got QROPs, but there you go, the UK Pension Super Fund. In fact, I can't see any, but I would use that as a naming right up front. I think that's, you can see here, Cliff Ford 55 plus. I would honestly go down the track and call it QROPs. We've got the initial fund members. Again, as I said, we've got those initial fund members, and that's for the purpose to ensure that we don't need to do application forms. That's where we're different. We make things easier. Why go through and have to go through all that crap if we can just make them party to the clause? And it's safer for you because you're advisors for it. So the trustee established a trust and super fund now as the QROPs. Now we go through that. That's all the stuff. First trustee, provide benefits for members. Everyone's consented and all that. Now what I've done is I've underlined here, the fund is to become a QROPs pension plan as that term is defined by the UK HMRC, and that was a trustee of the fund received pension transfers from the UK. We want this to be in their face. So we've got the name of the fund, initial trustee, operations of the fund. Again, the governing rules provide the fund is to be registered as a QROPs pension plan with UK HMRC on the basis regulated by the Australian Taxation Office, bingo, regulated for small pension plans. The Australian and UK governments have a extensive double tax treaty. 2, that's the second condition. And any retirement payment cannot be made until after the 55th birthday of the QROPs member, which I've got, unless it's for serious ill health. And then we obviously go to that guideline if we need be. So we sign that, execute as the deed, and you can see there, again, the initial members sign that. It's just safer and easier. Now let's go to the trustee, and I'll just go through what we're looking at. I've actually put as a preamble, this deed and set of governing rules have been drafted specifically to ensure the funds are QROPs. Now, you're going to find what I've done in here is as strong as you're going to get. And I want to just rush through pretty quickly because obviously I'll just be very mindful of the time and I want to make sure that that we're covered in here. This is in fact our new self-managed super fund deed, which will be launched next. Our new SMSF deed is going to be launched next Thursday. Make sure you come along to that. It's also going to have quite extensive, it's a world first in terms of superannuation plans in relation to digital assets. And anyone who's got an SMSF, you must come along to that session. Plus, also, we're going to be looking at a family protection trust, which is a testamentary trust that comes out of an SMSF. So, look, anything, book out 10 o'clock next week. Absolutely important to get there. So let's go down. Someone actually asked me this question no, I'll cover that next week. So let's go down. We're talking about the trustees and their broad powers. Trustees to ensure the funds are complying. Bingo, bango, bongo. Trustee to ensure the funds are QROPs at all times. At all times when the fund seeks to meet the conditions of QROPs pension plan for the transfer of pension monies from UK pension plan to the fund, the trustee must ensure that no time during this period, except for serious ill health payments, that any lump sum payments made before the 55th birthday. So that is rule 2.4 if we go down that track there. I don't think I'll put anything else. I'm sure there's got a couple there. I'm sure I need Ian Felberg, my good friend Ian, might get you to do a review of this one as well. You can see here I've actually put in a whole lot of new laws and conditions around the SMSF. Okay, so it doesn't look as though there. I think you'll find, or the other area I've got is the payment of benefits. So payment of taxes. Okay, so trustee to have a power to accept monies. So we're transferring pension plans. So I'll put in here, the trustee of the fund, if QROPs registered, is able to receive UK pension transfers provided all relevant conditions are met, and the trustee of the fund and the member have received specialist advice on the UK pension transfer. So we've put that essentially in there. So that's the receipt of the money. Now what we want to do is have a look at accessing benefits. For QROPs members, notwithstanding any condition of release under the super laws, the trustee is not paying any lump sum benefits unless the member has turned age 55. So again, we've got that right in the face. I've put this right up the front. QROPs lump sum only where the member is age 55. A serious ill health benefit only on specialist advice to the fund remains a QROPs SMSF. And I've also got down below QROPs pension plan. But essentially, that's not a really big issue. It's more about getting the money into the fund. So we've gone through the process HMRC. You can see here we've got it all signed. We've got lots of QROPs SMSF stuff there. You can highlight if you want. I've tried to highlight it. Send that off to HMRC. Bingo, bango, bongo. We've got up here now, we're going to have the man QROPs SMSF. We've talked to the fund administrator, and then essentially we go through the transfer process. Now, this is where things are going to get a wee bit sticky for us. So the first one, and I'll make a note of this, but if you've got a note there in your little, if you've got some notes in your hand, you might want to make some notes. So the first one is, we're looking at transferring. I'll just blow this up a little bit, if you don't mind. Oh, I can do it down below here. So what I want to do is I'm going to turn to see what happens with what is an Australian and what is a non-Australian or a foreign superannuation fund. So for that, I need to turn to section 295.95/2. So for that, so I've got 295.95.2, which some of you have seen. So I don't know why they've actually tucked this away. It's like crazy stuff. Honestly, I could tell any of you, and you might be experienced, to say, find out where the provisions of what an Australian super fund is, and hardly any of you would find it unless you've got a good, contents or nomination page. So 295.95.2 says, a superannuation fund is an Australian super fund at any time for the income in which that time occurs if the fund was established in Australia or any asset of the fund is situated in Australia at the time. So a UK pension plan would not be an Australian superannuation fund, but it could be, because if it held BHP shares, then it meets subsection A. But at that time, the central management control of the fund is ordinarily in Australia. And the Commissioner's got a whole lot of rulings on this. And look, this is not the subject of what a overseas or pension plan is. And we've got a whole lot of that 50% rule, which, again, I don't want to get too involved because we've only got about 15 minutes left. So the central management control of a UK pension plan effectively is set overseas. Now, John Mann is in Australia, so we've got number A. Yes, it's established in Australia. We just established that. Central management control, John lives here, so the trusteeship, we've got a company here, absolutely. So we've got that. At the time, either the fund has no member covered by subsection 3. So a member covered by, if the member is a contributor to the fund at that time, so definitely is a contributor. Now, if he keeps on contributing his SGC, once he turns 59 retired, he's not going to be a contributor. So therefore, it's always going to be an Australian super fund because C won't be. But he's an active member because he's contributing to the fund. And then what we do from that perspective is we then go through and work out 50% of the total market value of the assets of the fund attributable to super interests held by active members, and that they are Australian residents. So as it's just him and his wife, Susie, effectively they're Australian residents for tax purposes. So it's definitely going to be an Australian super fund. So that's our first tick, which is okay for SMSF. But we also know our overseas pension plan is not an Australian super fund, which means, again, that's going back to where I started. If I receive an income from that UK pension plan, it's not tax-free in Australia. To be tax-free in Australia, it needs to be an Australian super fund. So our QROPs SMSF meets that one first off. So now what I'm going to do is I need to go down to section 295, 200, and this is an absolute crucial one. So the next one is we're going to have a look at section 295, 200. So this is a choice that's made by the member. This is pretty important. So he's got that, what amount did he have here? He's got, so just have a look. He's got $450,000 he's bringing into Australia. And originally it was $60,000. Does that make sense? When he became a resident of Australia. So let's go through and we have a look at, what I'll do is first, section 305-80 and 70, because if he receives these directly in his hands, what is the consequence? So we've gone to the overseas pension plan. We're in Australia. We're going to take the whole amount out as a lump sum. We're going to take the whole amount out as a lump sum rather than put it into super. Does that make sense? So I'm going to take it all out of, I'm just going to get them to pay it over to me. We're not worrying about QROPs. I'm just looking at the worst case scenario. So here I've got, if you receive it within 6 months after Australian residency, then effectively it's tax-free. But obviously he came here in 1991, so it's not going to be the case. So what I have to do is I look at 295-70, and it says lump sums received more than 6 months after Australian residency or termination of foreign employment. So for that perspective, we've got John, who he's not investigating. He goes to his pension plan. They pay it out to Australia. Obviously, he may well be up for tax in the UK, but again, it's only going to be able to be taxed in Australia. So this section applies to a superannuation lump sum you receive from a foreign super fund, which is the UK pension plan. If you're an Australian resident when you receive the lump sum, and sections 305, 360 and 65 do not apply. So as this is over 6 months, they don't apply. So include in your assessable income so much of the lump sum, excluding any amount in subsection 4, which is your your undeducted contribution, as equals your applicable fund earnings. If you made a choice under 305.80, your applicable fund earnings less the amount covered by the choice. So the remainder of the lump sum is not assessable income, is not exempt. So what does that mean? Effectively, what we do is we go back and have a look at his figure there. So I'm assuming there we've got the $60,000 is what his amount was when he transferred Australia. So that's his account balance at that point in time when he transferred, and effectively that is tax-free in Australia. Now, the 450 less 60 is $390,000 is his accrued earnings. And those accrued earnings are going to be assessable income in his hands. So you can imagine if he had that $390,000, he's going to be up for virtually, you know, the top marginal tax rate. And who knows what the tax liability is going to be in the UK. So effectively what we've got there is we've got quite a significant issue there for us. Now, if I go down to 305, that's your applicable fund earnings, which we just had a look at. I can go down to 305-80, and it basically says, this section applies if section 305-70 applies to a super lump sum that's paid from a foreign super fund. Yes. You take and receive the lump sum. Yes. But all of the lump sum is paid into a complying plan. And immediately after the lump sum is paid into a complying plan, you no longer have a superannuation interest in a foreign superannuation fund. So here we're actually transferring everything from our UK pension plan. We can't do it in dribs and drabs as we did before. We have to transfer it all into our fund. Now, you may choose for all or part of your applicable fund earnings worked out under subsection 305-75. Remember, that was the $390,000 to be including the assessable income of the complying plan. Does that follow? So what happens there is he either brings it all in to Australia, pays tax on the $390,000, or he goes, sets up the QROPs, and then directs his UK pension plan to transfer all the money to the trustee of the fund, which is the Mann QROPs Proprietary Limited, as trustee for the Mann Family QROPs SMSF. Now, when that's transferred over, it goes into the superannuation fund. Now, what will happen is that applicable fund earnings amount, the $390,000, is assessable income of the fund. Does that make sense? So that means that if you're doing it this year, you need to work extremely hard to reduce that assessable liability. Because, for example, I'm just going to get my trusty old phone calculator out. Let's hope I've got the right one. There's so many damn phones these days. That essentially what we want to do is we want to have a look at $390,000. In fact, I'll just do it on the screen here. It's probably easier. Calculator. So what I'm going to do there is, let's assume if he's working full time, he'll probably, if I look at 390, if the worst case scenario, if he's on a top marginal tax rate, then he's going to be up for $183,000 tax. So he's not going to be overly happy to. Obviously, he can stage it over a period of time if he wants to get that direct payment. The easiest way, though, is to effectively go in, put that $390,000 into our fund. It'll be taxed at 0.15. So tax liability for, oops, sorry, let me just go back. So 390,000 times 0.15 equals. So we're up for 58,500 tax inside the fund. It's probably not a bad idea to go and have a look for franking credits, or essentially like an ESIC investment where you're getting a 20% tax offset. If he put, for example, $100,000 into an ESIC, then he's going to be, his tax liability be reduced by $20,000. So again, we want to make sure we do some minimisation in the fund. But effectively, you can see there's quite a big saving there from 183,000 down to 55. And remember, he's got that money now sitting inside the superannuation fund. And importantly, from that perspective, is that he can then withdraw that amount out a little bit later. Now, here's the big issue is we've now transferred in, going back in from the pension plan, his fund has now got $450,000. Now, we know of that, and I'll just put that in there, $390,000 is assessable, and a potential concessional contribution, which would mean it's an absolute nightmare for us. So what we've got to do here is we've got $390,000 assessable, potential concessional, and I'll just put a little bracket there, a question mark, and the tax-free $60,000 is non-concessional. So we're just going to have to watch out for his caps, but obviously with this one, it's not an issue. For some of your clients, if the amount in their pension plan when they became an Australian resident is quite sizable, you just got to be very careful about your non-concessional component. Remember, you can still bring that 3 year forward, but it doesn't hurt. You can still transfer it in beyond the non-concessional, and then you'll have a release authority a little bit later on. So that's that non-concessional amount is not a big area. What we're going to do is have a look at that concessional. Now I'm going to bounce back in and go down to my concessional rules, which is essentially section 291.25. Oops, sorry about that. So it's assessable inside the fund. We want to work on our tax liability. Remember the $53,000. Now we go down to 291. Oh, sorry, I've gone too far. 25. Okay, so that's all the tax offsets, sorry about that. 291, which is our concessional rules. So excess concessional contributions. So we're going to go down here, and we've got here, what is a concessional, we all know concessional rules is the actual law, tax offset. If you've got the excess amount, this is just to remind you, because we are going to do some tax planning. If you have excess concessional contributions financial year, there's no penalty tax. An amount is equal to the excess contributions, including your assessable income for your corresponding income year, and there's a 15% tax offset. So that's crucial. So we're going to look at that later on as we go down. Now, your excess concessional contributions, if we go down there, obviously are covered in there. Now, what is a concessional? Because I don't know what an excess is until I know what a concessional. So the amount of your concessional contribution financial year is the sum of all your contributions made under subsection 2 and each amount under 3. So the amount under subsection 3 is our reserves allocations. So we need to focus in on 2. A contribution is covered under this section if it is made in the financial year of a complying fund, irrespective of you. So that's our pension plan. It is included in the assessable income of the superannuation provider in relation to the plan. Well, yes, we know that because we had a look at it. Remember, we went back and had a look at 305.70, including our assessable income, but we've made an election under 305.80 to actually transfer that into the fund. Now, here we go, it is not an amount mentioned in subsection 295.200. So effectively that's our foreign superannuation amount. Remember, we've made that election there. So as a consequence of that, it's actually excluded from our concessional contributions. So even though we put it in, it's assessable in the fund, essentially it's outside the concessional contributions rules. So therefore, it's also not going to be a non-concessional contribution. So what we have here is that amount of $390,000 is completely excluded from all the caps, which is absolutely crucial. Also doesn't, look, if we're up at the 1.6 million, it's also excluded from there. However, the $60,000 would be included from that perspective. So if we have a look at it in a summary form, let me just go back to the slideshow. So if I have a look back in the summary form, John Mann has got 1994. We've gone through, remember that 8-step process. He's gone to his UK pension plan. We've done our Mann QROPs SMSF over in the HMRC. It's now on the list. We've had a chat with our administrator in the UK. The administrator now transfers it over to the bank account of the Mann family QROPs SMSF. So it goes in there. The $450,000 goes into that fund, and that's important. There's no overseas tax charge of 25% because, first off, it's regulated by the ATO. How do we know that? Because the HMRC says that, which is great. Because they've put it in there, it's a great guide to give to the pension provider, the UK pension provider. Secondly, it's got a double tax treaty with Australia. How do we know that? Because the HMRC says that. And the final one is our deed says you cannot take it unless you're age 55. Now, for John, it's not a drama, he's age 57. If he's age 45, it'd have to go in there, you wouldn't be able to access it. The good thing about it anyway is we can't access it anyway. And that means, like, temporary incapacity, wouldn't be able to take it in any way, shape or form, unless it's because of that serious ill health. Now, the $450,000 goes in. $390,000 is the fund's assessable income, which said there's around about $53,000 tax, but you need to start to reduce that with deductions, get credits like franking credits, also look for ESIC credits as well, tax offsets. Now, what will happen is the $60,000 will be non-concessional, but that's not going to be a big issue for John inside the fund or the trustee, because that fits under the $100,000 limit there. So he's now got his $450,000 in. I'd get that set up first. We then transfer his Australian super fund money in of $350. So he's now got an amount up there. This is all taxable component, as is the $390. The $60,000 is NCC. So we've got, in effect, $800,000 with $60,000 NCC. He's not quite pension age yet, but when he turns 59, obviously any growth that he earns on this will also be taxable component. He'll then set up in place a pension in Australia, and effectively it will all come tax-free. Now, that's a lot better than if he simply took that UK pension out of Australia, or took it in Australia where it's going to be fully accessible, or alternatively stayed in the UK, it's going to be fully accessible. For me, if you think about it, one of the best strategies ever would be for a UK person over there, and this applies also for expats. If you're a UK resident, you're seeing all the sun in Australia, why wouldn't you migrate out here if you are over 55 or over 58? So you can effectively do all this QROPs, and effectively it's going to be tax-free for life compared to what the tax liability would effectively have been in the UK. Okay, so anyway, that's enough for me. I'm sorry if a couple of you, if the sound hasn't been the best. It depends, obviously, where we are at the moment, particularly I was going to say the NBL, with the NBN, because obviously there's a lot of issues around that. But look, I'll get this rendered now. I'll get it up on the site and send it out to you with the slides and also the link to that HMRC. I'll also send you a sample copy of the QROPs as well, so you can have a look at that. But anyway, thanks a lot for turning up. There's a lot to work through, but I'll also put a slide in there of some of the issues around the Australian. Once we work through the actual issues, you find the transfer from a UK pension plan to Australia is the best thing out of ever, because it escapes the concessional contribution rules and also is not an excess non-concessional amount either. So it's a great position to be in. Anyway, it's Grant Abbott, signing off.